Hello and welcome everyone to our Risk Readiness webinar. I'm Ann Adams, the Senior Product Manager for Business Solutions at Risk Management Association. RMA is proud to make this presentation complimentary to our members. If you're not a member, please explore all RMA has to offer at rmahq.org. Today's webinar is the latest installment of Credit Trends in Commercial Lending, Credit Risk Navigator, presented by Tom Gronin from AFS. During the presentation, if you have any questions for the speaker, please submit them using the Q&A feature at the bottom of your Zoom screen. We'll address as many of your questions as we can at the end of the presentation. At this time, I'd like to turn it over to Tom from AFS. Thank you for joining us today.
Thanks, Ann, and welcome to everybody today. I'd like to start off today by reviewing our schedule for the rest of the year and into the first month of next year, 2024. Today, as I mentioned last week, we're going to do the executive summary demo and then get into the July 2023 results. In September, we will not be having this webcast. We have our user group semi-annual meeting, so that takes precedence over this webcast. We're back on October 26th. We'll do the second part of the Credit Risk Navigator demo. That would be the early warning webpage, and we'll be looking at the third quarter results. The end of November, right after Thanksgiving, we'll finish up the web pages, demo web pages with concentration web page, and look at October. Then we're off for December as usual, but then we'll be back January 25th, 2024 with our annual review of the 2023 data. So we've had a number of requests for a little longer look at the CRN dashboard. This is what we usually show when we start off. This is the Credit Risk Navigator. Pardon me. So a couple of people wanted to see a little bit longer demo, so I'm going to show you some additional slides today. Actually, I'm going to show you the live version of this. And we're doing this really because the ability to gauge your performance and credit quality is especially critical now as banks look to optimize their portfolios. And Credit Risk Navigator is one of the best tools available to help you do that. So we wanted to show you a couple examples of how banks are doing this, or using this tool to help optimize their portfolio. So the Credit Risk Navigator dashboard has 3 web pages that you see across the top: the executive summary, early warning, and concentrations. Today, we're looking at the executive summary. And what this does is enables a user to get a quick understanding of where a bank stands versus its peers, which would be the orange line or red line, and then the overall market, which in this chart is the yellow line. And there are 6 segments within this one web page. 1 for outstandings, which is what we're on today, right here. 2 for performance, the past dues and the non-accrual, and then 3 for risk or credit quality. And the 4 charts that you see in the middle, the big one, and then the 3 at the bottom, will adjust to match whatever segment you choose. So let's take an example and see how these will change. So let's look at non-accruing. So I'll just click on non-accruing, and you see the charts change. The bigger chart in the middle shows the overall trend in non-accrual for your bank, which is in the blue, your peers, which is again in the orange, and then the overall market in the yellow. And it shows you that from 2003 all the way up to the current time period. As this is, as we've mentioned before, the longest running commercial banking benchmarking service that's available. So it has all the information before the Great Recession. In this middle part here was the energy crisis, and then the spike up for COVID. The 3 smaller charts at the bottom show the more recent months. So here's July, there's June, and there's the end of last year. So how would a bank use this information? So let's go back, kind of concentrate here on the middle chart. And the results here, well, let's just say we're all part of Bank of Pennsylvania today, since I'm in Pennsylvania, and we're blue. So historically, this would say you've been basically better than the market, definitely better than your peers. But lately, the gap between you and the market has eroded. So what's happened to cause that favorable gap to shrink. So in the upper right-hand corner, we have these filters, and these are all the dimensions that are available within the Credit Risk Navigator. And dimensions, another way of saying segmentation. If you joined us before, you've heard me talk about these before, industry, geography, etc. Excuse me. So Bank of Pennsylvania, we know we've had some issues with ag loans. So what we want to do is see just how bad our ag loans are compared to everybody else. So we can come into the industry filter and click on the down arrow, select agriculture, and we'll click it and say apply it. And if you'll watch, the 0.6 is going to change here. And it's going to go to 339. And you can see now, if we look at the last, time period, our bank is at 339, whereas the market's at 247. So we're almost 100 basis points higher. And this is part of what's happening, why we're seeing that gap that we had talked about, that favorable gap, shrink. So what a bank would have to do here is lower its risk portfolio, or the amount exposure to the agricultural industry. All right. Another way that you can look at it, let me go up and clear that so that we're back to where we were, is a bank would be looking at, say, low pass loans. They want to look at credit quality. And on the RMA 10-point scale, 6 equals a low pass, and that's just above special mention. And in I've mentioned this before, again, in the CCAR work we did prior to COVID, we found a large percentage of 6s erode and go into special mention. So you want to make sure your 6s aren't out of line with the market, especially in some key sectors. So if we look again at the big chart, we can see that in the late, 2019, 2020, again, we're blue. We were sort of well above the market. Our 6s were too high, but lately they've come down and they're doing well. So we want to see why. So we're going to use the filters, and we'll go up, and now we're going to look at line of business. This is a demo bank, but one of the things banks do from time to time is tighten their lending standards. And we'll say that this bank tightened its lending standards on small business loans. So we want to see if that's what caused the low pass to come back down. More in line with the market. And you can see that it has. It's still relatively high, but you can see, again, we're the blue line. We were back in early 2020, we were well above the market. And now we've come back and we're just in line with the market. So what this would tell you to do is to maintain those credit quality standards, to not change anything or loosen up any of those standards. So we'll come back again in late July, and we'll look at the early warning webpage, which will show you some additional level of details. But for now, let's go back and look at the data. The credit trend. So let me open this up. Okay. So I'm going to start with a quick explanation of what's this on this chart and why we're opening with this. Pardon me. Again, got a little frog today. So the first line, or the blue line, is a 12-month change in consumer price index, and this traditional representation of inflation. The goal line, the other line, is the Fed funds effective rate. And I think everyone's well aware of both of these, but I thought it'd be worthwhile to see them side by side and talk a little bit about the impact. So the inflationary pressures that you see climbing there to almost 9% in July of 2022, and of course it went to 9% shortly thereafter, has caused many borrowers to experience lower profit margins. And now with the increase in rates, while the increase in rates has eased inflation, as you can see by the drop now, the blue line close to 3, the higher rates have meant an increase in borrowing expenses for many borrowers. So the combination of these two factors, and then the pressure on deposits, is making banks optimize credit portfolios. If you would, there's a flight to quality. And today we're going to show you some of the sectors to avoid. So we're going to start with C&I and a quick definition. When I say C&I, I'm talking about business purpose loans. And it's usually to companies with sales north of $1 million annual sales. And the loans are manually underwritten and risk rated. So exception or delinquency managed loans are not included in this portfolio. So here's the trend in delinquencies and non-performing. When I say non-performing, I'm talking non-accruals plus 90 days past due, 90 plus days past due. And the short-term delinquencies have jumped once again. If this is the first time you've joined us, we've commented many times in the past 3 years that on a month-to-month basis, delinquencies have become very volatile, especially in between quarter ends. So I'm not overly concerned about the jump July versus June, but I will watch this to see if the number moves above 0.5%. As you can see, we've been down below 0.5 for almost 12 months now. A movement up above there might be an indicator of some trouble. The non-performing, the dark blue line, is up slightly this month, but it's been relatively flat for almost a year now. And there are some issues cropping up. So let's take a closer look at the non-performing detail. So there are a few areas of concern. With this chart, we have a column for the percent non-performing for each 2-digit NAICS code. The line, the dotted line, is the overall market average. And any column above the line is performing worse than average. And this is why you'll hear me refer to this chart as our above the line chart. Pardon me. The two most notable above the line industries are 11 agriculture and 45 retail. Pardon me. Within ag, most of the problems are for nut trees, but there are some issues with dairy cattle. And then within 45 retail, the primary culprit here is sporting goods. And you might have seen the Wall Street Journal article Wednesday, a week ago, where Dick's had said it missed its second quarter targets, and they were slashing their sales and profit forecast. You also might have seen in the journal that Foot Locker and Champs are closing 25 to 35% of their stores. And this is all due to spending being down due to the impact of inflation, which we talked about as we came in, and also shrinkage, which is theft. And the theory is that that's due to inflation as well. Where we're seeing, so that those are those two categories. We're also seeing elevated levels for 31 and 32 manufacturing. And on the next slide, we'll take a deeper look at what's happening with manufacturing. So when we started examining the manufacturing, let me stop a second. So in CRN, we have the ability to go down to the 6-digit NAICS level. Here we're at the 3-digit level. And when we took a look at 31 manufacturing, we also took a look at 32 and 33. And what we found was that the troubles for manufacturing were really almost entirely restricted to just 3 subsectors. Those are the 3 that we have here. 312, which is beverage and tobacco. The problems is you drill down a little bit lower, the soft drinks manufacturers. 326 is plastics and rubber. And this is almost all plastic containers and due to the environmental pressure on reducing plastic usage. And then 335 is electrical equipment. And when you drill down a little bit lower, you see that it's all commercial lighting, which you think about a little bit more, and that's all related to offices and the problems that we're seeing with office vacancies and releases not being renewed. So we'll continue to watch the manufacturing sector to see if it expands beyond the 3, but for now, the problems are limited to just these 3 subsectors. Here we have the percent performing by location. And this is, again, it's the location of the borrower, not the bank. So if Bank of Vermont makes a loan to FedEx, this will come out as being from Tennessee. And we have 2 regions that are far from the average, one far above and one far below. The South is bad due to problems with agriculture, nursery, which is the nut trees. 31 manufacturing, the soft drinks we just talked about. 32 plastics, and 54 professional ad agencies. Conversely, what was once the worst performing region is now the best performing. That's the Southwest, as it's almost completely cleared out its energy issues. And as recently as the second quarter of 2019, the Southwest was the worst performing region, and the South was below or better than the average. And you can see now this is flipped quite a bit. Now we'll move on to our analysis of credit quality and a quick explanation of how we put this chart together. When a bank joins CRN, we take their native borrower risk ratings and map them to the RMA 10-point scale. On that scale, companies are tagged as pass with ratings 1 through 6, with 1 being the best and 6 being low pass. And the next 4 ratings comprise what are called criticized. 7 special mention, 8 substandard, 9 doubtful, 10 loss. And borrowers 6, rated 6, are low pass, as I mentioned. And we found during our CCAR program that a hefty percentage of 6 will worsen within 2 years. So we've added the 6s to the criticized borrowers and created columns of what I call distressed. And you see here, these columns are from July 22 to July 23. And you'll notice towards the middle of the chart, towards the beginning of 2023, the percent distress was getting close or dropping close to 15%, a very favorable outlook. But since that time, the credit outlook has deteriorated substantially, and distress is now at 20%. So let's take a look at exactly what is softening here. So we apply the distressed criteria again. So this is loans 6 and above, or 6 and worse, to the 2-digit NAICS level. And we've talked about the relationship between performance and ratings at length in the past webcasts. And I would suggest when you get a chance after the webcast, you pull the non-performing above the line chart that we showed earlier and compare it to this chart. And you'll see that there are a number of significant differences between industries that are performing poorly versus industries, if you would, that are projected to perform poorly. But here for July of 2023, there are 3 sectors that are above 30%. Agriculture is about 34%, 31 manufacturing, which we had touched on earlier, and then 72 restaurants. It's accommodation and food, but most of that is restaurants. And all 3 of these areas are not only criticized or distressed, but they're also not performing as well either. All right, let me take a drink. So during the past couple of webcasts, we've asked what type of data is most important to you. And along with performance stats, you've mentioned more than once that credit quality is important. So this month, we have a new credit quality chart. Here we're using the probability default measure. And just in case people aren't familiar with that term, this is the likelihood of a borrower going into non-accrual within a year. And we're showing the trend in the weighted average probability default for the top 5 or 6 industries segments. And you can see I've combined the manufacturing, 31, 32, and 33 into one, and I've combined the retail into an industry as well. And as you can see on here, the trend after COVID high point in July of 2020, the outlook for most of these sectors, or all of these sectors, as a matter of fact, was pretty good through July of 2022. Since then, there's been a turn to the worse for all these sectors, a worsening in their outlook. And I don't think it would take much to convince anyone that the increase was in reaction to inflation and the increase in interest rates, which is exactly how we started this webcast with our inflation and interest rate chart. So you could see there was a method to my madness there. Healthcare, the purple line, is up the most, and we'll talk about this some more later on when we look at CRE. All right, so now we want to start with CRE. And when we tag a borrower's CRE, being commercial real estate, we are following the interagency guidance that basically says if more than 50% of the loan repayment comes from the sale or rental of a property, that's CRE. And you'll often hear these properties referred to as investor owned. So we wanted to have a couple of poll questions here today as they related to CRE. So Anne, if you could launch our first poll question.
Sure.
All right. So this is, the first question is, do you currently have maximum LTVs, loan to values, for your CRE loans? And what we're looking at, so you could have phrased as maximum or minimum. So I was thinking of, to just have a limit where you won't go above. So the answer is yes, we have a certain limit. You can't go above. No, we don't have any limits. We'll do anything. The third answer would be depends on the property type. And then the last would be depends upon the individual borrower. So we'll give you a few seconds to answer this.
Okay, thank you.
All right. So 72%, nobody has, that's a good sign that nobody has none. And then, so 3/4 of you have a limit. All right. Okay, I think, Ann, I need to close that. And then we'll go to the second question. So here I assumed that most of you had maximum LTVs. And so the question is, what are they? And the first answer would be 90% or higher. The second would be 80 to 90%. Third, 70 to 80%, less than 80%, and then less than 70. And if you don't have a maximum, or I think everybody said they did, select 90% if you would. So again, we'll wait a few minutes just to see where everybody is here.
Okay, thank you.
All right. So 3% go 90, 29, 60, or it's 70 to 80. Okay. All right. And we have one more. And this is, we're seeing how good, this is kind of a trick question because this will come up in a few seconds. So other than office, are you concerned about any other property types? And we've listed the major types here. So industrial, which includes warehouses, self-storage facilities, multifamily, healthcare, which could include hospitals, medical office buildings, things like that, lodging, retail, residential. This is 1 to 4 residential. Other, if you're concerned about golf courses or something like that, or none, if you have no concerns about any other type of real estate. So just curious how people are feeling here.
Okay, thank you.
All right. So 20% multifamily, 7 for healthcare, 35 for retail. Okay. And 5% none. Okay, very interesting. We're going to talk about this in just a few seconds here. All right. So let me come back in. All right. So I often, this is our CRE non-performing and delinquency trend chart. And I often compare this performance chart with the performance chart we have for CNI. And the two charts are relatively similar, with one major exception. And that is how each market has recovered from the initial shock of the COVID closures. If you go back to CNI, you'll see that it's completely recovered, and the non-performing measure, pardon me, is now actually lower than when COVID hit. As a matter of fact, the CNI non-performing measure hasn't been this low since before the recession. So it's doing really, really well. For CRE, however, non-performing is below the high point of COVID, the COVID impact in early 2021, but it's definitely not back to the pre-COVID levels. It just hasn't recovered all the way. And on the next couple of slides, we'll take a look at why this has happened. So here we have the percent non-performing above the line chart for the major property types, where major equals the largest outstandings. And let's focus on the three with the highest level of percent non-performing. So lodging is the worst, at a little bit above 3, but it continues to improve. A year ago, this was at 5.5%. It's now at 3.2%. And it's improving primarily because a lot of people are traveling again. Business people are traveling again. Hotels are filling up. The RevPAR is increasing. So it's getting close to being back to normal. Slide over to the right a little bit, and office is the second worst, but it has deteriorated the most. Probably not a surprise to anybody. A year ago, office non-performing was 0.26%. Today, it's 2.7%. So tremendous increase. And as I mentioned, when we were looking at the weighted average PDs for CNI, the performance for healthcare properties has slipped too. So you go over to the far left. In July, healthcare was 2% non-performing for healthcare was 2.3%, and now it's 2.7%. And I noticed I'm glancing back at the poll responses, and only 7% of the people said they were concerned about healthcare. And what we're seeing, and what we heard, actually RMA heard at a recent RMA roundtable, several attendees mentioned weaknesses for doctors' offices that are struggling with staff shortage, as once again, another lingering COVID effect, nurses are quitting. They've just had enough. So the reason why CRE is not improving is that the improvement in lodging is being offset by the declines in office and health properties. So now we'll move on to CRE credit quality, and we'll look once again at loans to distressed borrowers, 6, 7, 8, 9, and 10 rated. And a quick comment, if you would, the column you see there for June, assume that is equal to May of 2023. We had an issue with a submission, and that file is being resubmitted, and we're positive that that number is going to be up at least to where May was. So that being clarified, you can see the overall credit quality over the last year has deteriorated quite substantially. Low pass, which is the dark blue, over this period has grown from 12.2% to 15.2%. And classified, which is 8, is also up from 1.9 to 2.4%. So not only are the loans that are shaky, but the loans that are actually having problems have risen too. So let's take a look and see exactly what's happening here, what's going up. So our above the average, above the line chart one last time. And for the first time since we've been presenting this chart, the credit quality for office is worse than the credit quality for lodging. Again, probably not much of a surprise, but it just shows you how bad office has gotten and how well lodging has improved. And how bad offices will get going forward is open for debate. But I checked the Castle System numbers earlier this week, and the return to office seems to be stuck at slightly less than 50%, with some vast regional differences. For example, San Francisco, New York, and Philadelphia are at 41.9% or lower. And conversely, the Texas cities of Houston, Dallas, and Austin are all between 54 and 60%. And we're now hearing a lot about office to apartment conversion activity picking up. And I don't have any specific stats on that, but maybe the conversions will be the savior for your office loans. We'll see what happens there. Unfortunately, there are significant zoning and infrastructure challenges facing customers that want to do that. What did surprise me here, besides the healthcare, is what's following lodging. So office the worst, then lodging, and the next worst is industrial. And so apparently, the predicted demise of shopping in person was erroneous or overstated, as e-commerce sales have now stalled at 15% of overall retail sales. And despite the bankruptcies and closures of stores such as Christmas Tree Shops and Bed Bath & Beyond, people have been going out to shop. So all the warehouse space that was being built over the past 2 to 3 years in anticipation of e-commerce continuing to grow is now becoming excess space. Recently, there was an article again in the Journal that Amazon had closed, canceled, or delayed opening 99 facilities since the fourth quarter of 2022. Close to where I am, Giant Food is closing 3 of their East Coast fulfillment centers, and there have been numerous reports of spec warehouses just standing empty. So the industrial properties, the outlook for those are not as favorable as they might have been. And so I'll wrap up this part of it by saying, does anybody want to go back to the last poll question and change your answer? So that concludes the webcast. Please complete the survey that follows. I use that to understand what you want to see, and I've made a number of changes to the webcast over the past few years based on that feedback. So Ann, I'll turn it back to you.
Thank you. Now we'll just open it up to any questions. I don't see any in the queue, but we can give it a minute or two. Tom and I can stay on for a little bit, but otherwise just want to say thank you, Tom, for sharing your insights, and thank you to everyone for joining us today. We look forward to having you at our next session on credit trends. So this will conclude our webinar, and please take a moment, as Tom mentioned, to complete the event survey at the end. Thank you and have a great day. Oh, wait, we didn't get a question.
Okay.
Hold on. Oh, it was just a thank you.
Okay. Those are the questions I like.
Yeah, exactly. And an excellent thank you.
Yeah.
Okay, now we did. Let me do an answer live.
Okay.
So industrial is worsening due to more commerce or less.
Okay, I assume this is industrial worsening due to more e-commerce or less. And the answer is it's due to less e-commerce. If I remember the statistic correctly, e-commerce sales at the height of COVID rose to close to 16% of all sales, and now it's dropped back down to 15%. Doesn't sound like a huge number, 16 to 15, but when you're dealing in, I guess, trillions of dollars, that's a big number. And I think you've seen, particularly with Amazon, they've been laying off people, that just the amount of online sales that we had, late 20, early 21 has just disappeared. And so all these warehouses, they just don't need that amount of space. Yep.
Great. We will be sending out the slide deck after this concludes. And we'll again stay for a few minutes if there's any other questions. Otherwise, thank you and have a great day.
All right. Thank you.